Welcome to the March webinar from Principal Wealth. I'm Julina Ogilvie, a partner and wealth advisor, joined by our founder and CEO, Bob Paolucci. Bob, good morning.
Good morning. Good morning.
Yes, the title this month is rebalancing. And there's a number of reasons that we titled it this way. If you want to kick it off by explaining that.
Yeah, I think this will be one of the more watched videos. Whenever we get some market volatility, everyone pays attention or wants to tune in. Rebalancing is a great title because you have the world rebalancing, you have policy rebalancing, you have trade rebalancing. We have portfolios rebalancing. I think a lot of our clients have seen some activity lately, trying to take advantage of new themes and trends and things that we're picking up on and opportunities that we see, and there'll be more. So yeah, it's everything is rebalancing, which is completely normal whenever there is a leadership change in the United States and elsewhere.
Yeah,
But that is what we're going through right now, and that doesn't mean it is bad.
yeah.
But there's certainly a little bit more volatility being priced into the markets, which we will uncover and articulate to everybody.
Yeah, I think that's a very important point. And again, it hasn't occurred in quite some time, so it feels abnormal. Let's kick it off by talking about today's topics, which is really going to be broken down into four key areas, which is we want to summarize what we've been talking about for the first 2 months of the year, and then walk through the markets, the economy and policy, and then our everything else sort of bucket.
Yeah, there's a lot to cover, but the most important one is dissecting the myth versus reality. And I think the average person or the average client of ours could be listening to the financial media thinking that the sky is falling.
Mhm.
It's not. I think a lot of people think that every asset class is down significantly this year, and they're not, and that the world is ending,
Mhm.
and it's not. And we'll get into that right now.
Absolutely. And I think before we really dive into where we think we are, I think it's really important to kind of summarize what we've been talking about so far this year.
Yeah, I
And
think we have a lot of fun bringing up the prior month's data points
Mhm.
because it seems like we predicted this.
Yes,
So I don't want to speak on your behalf or anything, Jelena, but you're right, right? So what did we say in January and February?
absolutely. I mean, there was a number of things that we articulated that are we're currently seeing occur in the markets right now. Everything from Doge to the earnings, buybacks, the stock market continuing higher, regardless of what we're seeing with trade wars and fiscal policy. We expected a pullback. We've said this multiple times. And so hopefully our clients aren't too surprised by what we're seeing.
I think for those that talk to us and those that listen to our content and our videos, we in January said, and I know it didn't feel like this, but we said, we're probably going to see one or two pullbacks of greater than 10%. And we're not there yet, but we said we think we are in one.
Right.
Uh, it just didn't feel like it at the time. It feels like it now.
Correct.
We think this is going to be one of them, and we think there will be another one later this year. But that's actually normal. The past 2 years have been abnormal
Correct.
for many reasons, and we'll go into that.
And I think it's also important what you just said that we haven't even seen a 10% pullback because a lot of individuals think we're already there, but we're gonna go through that.
Right.
So let's talk first about the markets and the fact that there are several rotations occurring within the market.
Yeah, so the first one here is the most popular stocks, the ones that everyone talks about on TV ad nauseum all the time, 24/7. But they also happen to be positions that a lot of investors own, the widely held stocks, the stuff that has run up the most, cools off the most when things cool off. And like clockwork, you're seeing it, right? Something we, again, specifically talked about. The Mag 7. Looking backwards, it's now very easy to see that it's really these seven stocks or even the top 20 stocks of the S&P 500 that carried the entire market for the past 4 or 5 years,
Yes.
most of them being technology. So what does that mean? That means the opportunity in the market where there was earnings growth, where there is earnings growth, was limited to a tiny amount of stocks. You could say that when you look at all of the sectors in the market, the one that really stood out in a positive way was technology. Why? Because regardless of policy, it finds a way to grow. It's very innovative. It captures the world's wallet share. It spends a lot of money, creates a lot of product, creates a lot of positive change, and then shareholders reward that with purchasing more shares, loyalty, all that stuff, and prices go up.
Yep.
But what you can also say, the negative space in that is that there wasn't a lot of opportunity elsewhere. Small caps and mid caps in the S&P 493 did nothing for the past 4 or 5 years, which is why we were very underweight those parts of the market. And part of that is through the economic policy that we had, the very strict, restrictive FTC policy that we had here. So no mergers and acquisitions, not a very pro-growth environment. Now we have a change. And again, the best companies can grow through a less pro-business environment, but most companies rely on a more pro-business environment, and most sectors rely and want a more pro-business environment. So that is why you're seeing some of the rebalancing from the top find its way going down river into some mid caps and small caps, into some value sectors like financials and energy and utilities and consumer goods, where, if you wanted to invest in those over the past handful of years, you had to hold your nose. You weren't getting a return. You pray that you got a dividend.
Yep.
Right.
Absolutely.
So now they're getting some attention. However, the attention is being sort of pulled away from, and the money's being pulled away from the Mag 7,
Yes.
right? So the Mag 7 is taking it on the chin on behalf of the rest of the market. And what you see here, and let's not overreact, but this year through yesterday, March 6th, today's Friday, this year, Alphabet is down 9%. This is the Mag 7. Amazon is down 9%. Apple's down 6%. Meta's actually up, but it's off its high. Microsoft is down 5%. NVIDIA is down 17%. And Tesla is down 35% so far this year. However, if you've had these securities for the past 5 years, worry not. You're still up 167% in Alphabet or Google. You're up 111% in Amazon, 230% in Apple, 250% in Meta, 150% in Microsoft, 1,500% in NVIDIA, and 461% in Tesla. Now, I know everyone likes to move forward and see higher balances every week and every month, but it just doesn't happen that way. Normal investing gives you a bad quarter, 3 good ones, a bad quarter, 3 good ones, 2 bad quarters, then the next 4 are good. That is the normal cadence that we're going to be in going forward.
Right.
And things are looking up, earnings are looking up. Just, to take this pullback with a grain of salt here, zoom out and understand that the cooling off of these stock prices attracts other people to buy the shares that maybe haven't bought them in the past.
Correct.
Seeing that the price to earnings ratios of these stocks, of these highest quality stocks with the best balance sheets in the world, with the best products in the world that are the most in demand in the world, the balance sheets are pristine. The companies are now much cheaper. The PE ratios are significantly lower, and their prospects for growth are still wonderful.
Absolutely.
So, zoom out, take a breather, take the emotion out of what you're hearing on the financial media, certainly any political talk. Just view the facts as they are. So here we are.
And I think also, despite the short-term performance from the Mag 7, that is not occurring throughout the rest of the market.
100% correct. So when we're talking to our clients, they're shocked that their portfolio is hanging in there.
Yeah.
Well, that's what a diversified portfolio does, right? Certainly you'll be shocked when, 8 stocks rise by 50% and you have a diversified portfolio that owns just more than those 8. Yeah, you're never going to participate to the upside unless you want to bear the risk of just 8 stocks. But when there's turbulence, the diversification activates. So there's the S&P 500, the 500 largest publicly traded stocks in the United States. But then there's a bigger index, the Russell 1000, the 1,000 largest publicly traded stocks in the United States. And we split this into 3. In aggregate, growth and value glued together in the singular index.
Hmm.
But then we spliced out value stocks, the dividend payers, the value sectors, the more conservative side of the market,
Hmm.
and growth stocks, right? The
Correct.
tech companies, the earnings growers, the companies that spend a lot on research and development. And what you see here is a tale of two markets, or really a tale of two styles.
Hmm.
We own dividend paying stocks for our clients, through various products, sometimes outright, and they're up this year,
Yeah.
right? So I think a lot of people forget that there's a part of the market that's up. There are many parts of the market, both bond and stock, that are up.
Right.
It's one real part of the market that's down, and it's the stuff that has been on fire to the upside over the past couple of years, the top growth stocks.
Yeah.
That's it. It is really the growth side that is getting repriced. And
Yeah.
that's always what happens when there's a little, confusion and volatility in the market, especially coming after 2 years of 20% growth in many of these securities. Uh,
Yes.
so it's the growth side that is pulling off.
And it's amazing. It's an 8% differential between these two indices, and we're just in 9 weeks in the year.
That's right.
And if you look a little bit further out over the last 5 years,
Yeah. So
um,
now you're right, Julina. So zooming out to 5 years. So we just showed you growth versus value, and then also in aggregate glued together.
correct.
It is now zooming out 5 years. So yes, value is doing well. It's positive year to date, but what a huge lagger it has been over the past 5 years, up 73% versus growth up almost double, 131%.
Yeah,
Right.
absolutely.
So you do have to zoom out and look over longer periods of time. Yeah, conservative stocks do well when there's more volatility.
Hmm.
When there's less volatility and more knowns,
Yeah.
more predictability around policy and all this other stuff, and in a normal rate or lower rate environment, yeah, growth outperforms. That's
Yeah.
just the way it is. It's more
And,
volatile, but it outperforms.
and we're talking about all companies that are domiciled in the US, but let's take a look now at the US relative to the rest of the world.
Yeah, so this year, or really specifically the past month, foreign stocks, which have been in the dumpster for 20 years, started to wake up.
Hmm.
Not because there was actually a lot of outright buying of foreign stocks. What we're showing you here is foreign stocks in orange, the ex-US index.
Hmm.
So it's the rest of the world minus the United States, and again the Russell 1000, the 1,000 largest U.S. companies in aggregate. The rest of the world is up 8%. U.S. is down a couple of percent, glued together 2%. What happened? Well, just like there were elections here in the United States, there were elections elsewhere. And in Europe, they've been living under, as the media refers to it, socialist-like economic policies for a very long period of time, with a focus on caring for their people, with no focus on growing their economy, creating pro-business policies. Now that there's been a leadership change, many actual leadership changes in Europe, there's a bit of a wake-up call. And now Germany is talking about the amount of debt that they have and how they plan to deal with it. They're talking about being very pro-business. They're talking about changing a lot of the policies that they have. They're talking about their budget and how it's going to focus more on economic growth. I mean, we haven't heard this in a very long time. And that came out of left field. It really didn't. It's needed. It's been needed for a very long period of time.
Yeah.
And what happened here is a lot of institutions have been shorting, betting against, putting money against foreign stocks for a
Hmm.
very long period of time.
Yeah.
And what recently happened was the institution said, uh-oh, we have to cover our shorts. So what they did is they bought back the short positions that they had betting against the foreign markets, which sent the foreign markets up. Because ultimately, there has been no radical economic growth. There's been no radical change to corporate earnings, right? There's
Hmm.
no real reason to buy these securities other
Right.
than the idea of, hey, we might have more pro-business policy in Europe, which is something that, I haven't said in the same sentence in a very, very, very long time.
Uh,
I'll believe it when I see it. I think
More to
this is,
come.
yeah, I think this is an emotional technical jump.
Yeah.
Uh, we did and still do have plans to dissect the foreign investment landscape and add to it throughout the year. We just want to watch the grass grow first before
Mhm.
we start rebalancing into it. So
Yeah, and I think a good visual of explaining the U.S. outperforming the rest of the world, at least over the last 5 years, has been pretty dramatic.
yeah, I mean we're showing you the past five. We could show you the past 25, and the growth ex US in foreign markets versus US, it's a night and day.
Yeah.
This is actual double the performance in the US, the purple line, versus the non-US line. It's been really a one country market investment thesis that has been pushing, really the world economies and the world invested dollars higher. You had to be overweight US, and I still think that is certainly the case. But I think it might be time to take a peek at some foreign securities soon.
Okay.
Yeah.
Yeah. And I think a good explanation, oh, excuse me, of our home bias. I think this is a fascinating visual of US versus European companies.
Well, this proves it out, right, Julina? So these are U.S. versus European companies less than 50 years old,
Yeah.
with a $10 billion or greater market cap. And yeah, Europe has some 3, 6, 9, 12, maybe 12 to 15 of them, but they're tiny.
Yeah. And Bob, just to clarify, 10 billion is usually sort of the number to get into the S&P 500.
Correct. Correct.
About.
Yeah.
So,
So in other words, if you were to reweigh the
mhm.
S&P 500 and include these European companies, it's a cap weighted indice.
Yes.
Companies would be at the bottom. There would only be about a dozen of them. So, you look at the U.S., this dot plot of the U.S., you can see the U.S. dominance
Mhm. You can
over
read the names maybe
over
on
the
the
yeah, you could
slide.
read the names for the past 50 years. I can't even read the European names, but we cheated because one of them we had Kyle in our office zoom in. I think the largest one is Spotify,
Yeah.
which is the which is the free radio company.
Well,
Or
I think hopefully people can see that there's clearly been a rotation in the market. Not everything is down. Yet, despite all this, there is this fear that's out there. And, I love the Warren Buffett quote that we need to be greedy when others are fearful and fearful when others are greedy. So,
yeah, and you have to buy when there's blood in the streets. You've all heard that. Well, there's
yeah,
no blood in the streets. There's just a lot of nail biting going on,
yeah,
right?
yeah,
Uh,
okay.
and there's just if we didn't come off of 2 years where the stock market went up 20%, a 6% pullback from all-time highs, or a 2.5% pullback so far year to date, you wouldn't even blink at it. But what is wild here is this is a professional investor survey, yet it is a contrarian slide. Some of the professional investors turned bearish in February.
Mhm,
Why? Well, because the market went down.
mhm.
It's very simple, right? But we love this one because whenever the bull bear ratio, it's bulls minus bears, when you get to a level around, negative 40, negative 50, right now we're at negative 40,
Mhm.
the future returns are outstanding.
Yes.
So whenever you get this level of bearishness amongst professional investors who over anchor on policy change, at this level, historically, you see the forward 3 month return, 6 month return, and 12-month return is positive, just about 90% of the time, with average returns being next 3 months, 6.5, next 6 months, 14%, next 12 months, 22.3%. So, really, in English, this is a slide that says, yes, even professional investors get bearish when the market goes down, but don't worry, when the market goes down, it goes back up,
Yeah,
right?
these are some
Some of
of the
that.
best probabilities you can find when you look at market returns.
Absolutely.
Yeah.
Absolutely.
Yeah.
So again, there's opportunity here.
And I really like this next slide talking about companies and how they need to adjust to different business environments.
Yeah, there's macro stuff like global monetary policy, global economic behavior, global business cycles, big macro
Mhm,
data, right?
mhm.
But when there's some policy change, when there's coming out of a pandemic, when you're done with the world chaos stuff, you get back to the micro data, very specific to a sector or a country
Mhm.
or very granular policy. Right now, we're living in the micro world, and pretty soon we'll get closer to more macro themes. And if we look at the macro themes, you are starting to see some really good things or better things shape up globally, like China is providing stimulus to their country that is absolutely in a recession. They are trying to treat their crystal clear real estate debacle that's going on, and they are trying to make their consumers more confident and happy by providing stimulus, bringing the cost of money down, the stuff that we have done historically.
Mhm.
That's good. Macro, Europe is starting to talk more pro business. And then you have the US, where we have great economic growth. We'll have a little bit more unemployment. We'll have lower rates. We have tremendous earnings growth. You'll probably have a deeper market, more participation amongst large cap, small cap, mid cap, value and growth. Pretty soon we'll get back to the positive macro stuff. Right now we're getting a little too granular, getting caught up in singular headlines and data points. And
Sure.
that is a scenario where it gets, a little bit more volatile. So we'll
Yeah.
be pushing away from this very soon.
And I would say when you say we, you're talking about the market in general. Um,
Everyone on the planet, and
yes.
every news station and every forecaster with an opinion, they're starting to talk about fourth tier
Yeah.
granular stuff. It's like, okay, it matters for a week.
Yeah.
Uh, let's move on.
And our recurring listeners and clients know that we still focus on some of the macros and earnings being certainly one of them.
Absolutely. So you have a last quarter left, this quarter right, before and after. Earnings are higher. What we're seeing specifically in the pink box is earnings in the S&P X technology. Last quarter were up 6%. This quarter they're up 12. So we've been, beating people over the head with this one for a while, talking about no, we're going to have more participation when it comes to earnings and who is earning the earnings.
Mhm.
And here we go. We see it. A data point that came out this morning, I read that finally the 2024 full year earnings have come in. 98% of them have come in. Last year we had just about 13% earnings growth, which is well beyond the average year of about 8.4.
Yeah.
So the stock price move last year and the year before was certainly justified. Earnings
Mhm.
went up substantially. So there you have it.
Yeah, and I think one other point really quickly is that the fact moving forward that we've talked about is that the earnings are going to be much more diversified. The one thing I want to point out is the companies that are ex tech, the earnings have doubled from quarter to quarter, and so I think that's just another example of this theme that we've been talking about.
Yeah, it's easy to say they went from 6% earnings growth to 12% earnings growth, but really on a percentage basis, you're right. It's a 100% more than 100% increase.
Yeah,
So
absolutely.
great opportunity.
Another topic that we always love to talk about and keep an eye on are the buybacks, and we've seen this nice little pop.
Yeah, so when we were talking about over the past couple of videos, the foundational elements of the economy and the bull market, the bull market, the capital markets, what's supporting it is many things. That's why we're talking in a very excited way because of the opportunity set. You have $8 trillion of cash on the sidelines. If you don't have cash, you don't have the ability to have money come into the markets, both bond and stock, nor do you have money to spend and consume things, right? We have
Mhm.
the greatest level of cash we've ever seen in history. It's not even close,
Not
right?
even close.
During the pandemic, when all that free money was handed out on top of the money that was on the sidelines, that only
Mhm.
came to about 5 trillion. We have $8 trillion of cash on the sidelines. That's a lot of support for buying stocks when they dip, for buying bonds, and for spending money if need
Yeah.
be. On top of that, you have rising dividend payouts. So companies are increasing their dividend payments. You don't increase your dividend payments when you're short on cash or you see that your business is struggling.
Mhm.
They're increasing dividend payouts. And then another layer that has really broken a good trend in a even better way is the amount of buybacks announced by companies during their earnings calls saying, hey, we're increasing dividends on top of our earnings growing. We're also going to allocate in future quarters $10 billion to buy back stock. When you cumulatively add up the dollars buying back stock, we have reached
Mhm.
a new commitment level that plays out over the coming quarters. So there's so much money being committed to buying back shares of companies by the companies themselves.
Yes.
They are a big buyer of securities.
Yeah.
Uh, that is a very good thing for the market. Get ready, good things are coming.
Another reason for optimism. And let's transition and quickly talk about the volatility that we saw in February and then some of the opportunity that we might see going forward.
Yeah, so this chart we showed last month, we expected some volatility and here it was. This is actually a historical chart of February. What
Mhm.
typically happens, it's almost identical to what happened, right?
Yeah.
So right around Valentine's Day, mid-month, you had the market sort of peak out a little bit, ran out of steam, and it's been coming down ever since.
Hmm.
But that's historically, again, February is the worst month of the year.
Yep.
Uh, that's historically what happens. So this is a chart over a 70-year period of time. It just so happens if we put the actual February chart up, it's overlaid perfectly.
Yeah.
Getting a little bit more granular, if we go to the next slide,
Hmm.
whenever you have a new president come in, um, the first quarter of the forward calendar year, it's always rocky or not the best.
Yeah.
Why? Well, with a new president, doesn't matter if it's Democrat to Democrat, as long as it's a new president, Republican to Republican, Democrat to Republican, Republican to Democrat, as long as it's a new administration, you have the repricing of the promises they made, how are they going to do it, policy change, personnel change, right? The
Yes.
mood change, the markets have to digest stuff, the institutions have to digest stuff. There's rebalancing that happens usually in Q1 on top of it. So this is absolutely normal, and it's playing out this way again.
Hmm.
One click further into the granular abyss on a monthly basis, this is what it looks like.
Yes.
Now this is showing you monthly performance post elections going back the same 70 plus year period of time. You see January is usually positive, but February you get a lot of pricing in, right? Because ultimately inauguration doesn't happen until the end of January. And then the real emotions kick in when there's change, usually in February. It's playing out perfectly. What you do see here, we tried to point out subtly in this navy box here, is that March, April, May historically tend to be pretty good.
Yep. Is it really cheesy to use the airplane analogy where if you've been flying a plane on a plane for the last couple of years and you haven't needed your seatbelt, you're telling us right now we just need to put our seatbelts on. We're expecting some turbulence, but it's not necessarily changing the path.
I would agree with that statement.
Okay. Let's quickly talk about the better days ahead and
Yeah, so when you chart it out, through this graph, it looks friendlier for sure.
yeah.
Past 20 years, again, now taking out just presidential change years. Now this is the past 20 years.
Mhm.
Past 20 years, well, this is the path on average of the year, anyways.
Yeah.
And very likely could be the path that we experience this year. Now, what I should tell you is, again, we still expect a very Jekyll and Hyde type year. First half of the year, volatility, pricing in new stuff, new policy, and the unknown. And as time passes, as the months pass, as the weeks pass, more knowns will find their way in. We'll know a lot more in the coming weeks and months. So will the market.
Yeah.
And what you'll see is volatility levels will tend to come down. The opportunity set rises, prices start to rise. We expect the same thing to happen this year.
Yeah, that's great. And let's quickly address the bond market and what transpired very recently.
Yeah, so we have talked about the 10-year treasury being the limiter, in essence, the speed limiter to the stock market. And if the 10-year treasury gets too high, typically at a level right around 5%, the stock market will have a hard time justifying, moving much higher unless that 10-year treasury can come down a little bit off of its high.
Mhm.
Now, again, I think what a lot of investors don't know is you've heard how the longer term interest rates, the 10-year treasury has crept up recently, certainly more so over the past 3 years or so. And you've heard this 5% level from a lot of people. But Julina, a little trivia for you. Over the past 5 years, 15 years, 10 years, how many times has the 10-year US Treasury closed with a level above 5%. Like if you total up the amount of times it's closed at a level above 5%, what do you think the total is? 20 times, 30 times? I mean, this is like daily over the
Yeah,
past 5, 10, 15 years.
that's why you have the question mark at the bottom of the slide.
Yeah.
Yeah.
What
Zero.
do you think the average person would say? Maybe 30 or 40 times?
Sure.
Yeah. Yeah. The right answer is zero.
Yeah.
Zero. There's been a lot of
Amazing.
talk of rates going higher,
Yes.
of the 10-year treasury going higher and higher and higher and higher. And if you listen to a lot of these forecasters and economists, you've probably heard it 200,000 or 300,000 times over the past 5, 10, 15 years, but not a single time,
Yeah.
not one time has it closed above 5%. It got there a
It,
few times,
it can get
intraday,
close. Yep.
but it didn't close there. That's
Hmm.
a clear resistance level. So 60 days ago, the 10-year treasury was at about 4.9. And here we are 60 days later. It's loosened up a bit. It's down to about 4.25. So this higher for longer narrative is a bunch of nonsense.
Hmm. I think that that's a great visual here.
Yeah.
Thank you for going through that because I think that's important. And let's transition to the economy in general. I love this slide because it really depicts the fact that the economy has the cycle. In essence, you can break it into four key areas.
Yeah, it's almost like the seasons, right? And the
Right.
seasons have traits like the leaves start to fall, they change color, the temperature, winter blows in, the snow happens, the ice happens, the deep dark depression in the Northeast mentally happens, all
Mhm.
that fun stuff. So just like there are seasons that we have with weather, we have seasons in the business cycle and the economy. There's the early season, which is, hey, the market and economy is recovering. It's coming out of a recession,
Mhm.
right? It usually happens pretty sharply and a very unexpected. I can't believe things are good when the data still looks bad. Well, the
Right.
data looks backwards and everything else is looking forward, right? That's where the confusion comes in. Then
Sure.
we get into the okay, things are good period, which is the mid cycle
Mhm.
where everything just looks better and continues to look better. Then we get into a more mature version of that, which is called late cycle, which is still actually very good. It's just, things start to change. This would be like the 2019, 2018 period.
I was just going to say that.
Got 8 or 9 or 10 years into a bull market. It's like, all right, so just the future looks okay, just doesn't look as bright as it did. And then you have a recession, and then nothing looks bright, everything looks down, and then quickly you find your way out of it. It's usually a couple of quarters, maybe 3 quarters maximum, and then you get back into the early cycle and
Right.
rinse and repeat. That's how these cycles work.
And it's very linear.
It's very linear, yeah.
Yeah.
And what has been happening, and we have talked about this over the past couple of years, is because of the pandemic, it threw everything and everyone out of sync,
Mhm.
right? And there were parts of our economy that recovered first, other parts that recovered later, some parts that were very slow to recover, and some that haven't recovered. Some of the economic data was looking very positive. Some economic data at the same time was pointing very negative. And what we really needed was time beyond the world shutting down for the first time ever in history to get a much more predictable pattern, to get back into a normal cycle. Well, we're getting there, but we're still not there yet because you have this view that is all over the place. Are we in the early cycle, the mid cycle, or the late cycle? We've been saying we have we have a scenario where, in many cases, spring has sprung, but the leaves are falling off of the trees and turning brown, but it's 100 degrees outside, yet it's snowing at the same time. Does that make sense? Right? We've had sort of a combination of all parts of the cycle happening for the past handful of years.
Mhm.
And when we look at the major themes that are part of these cycles, the major themes are telling us we are more mid and early cycle than we are late cycle, right?
Yes.
And now you are seeing a lot of these big firms starting to agree with that thesis. One of them put together this slide, which we are hijacking for our presentation, and they called it the Benjamin Button economy, aging in reverse. Now, that's a wonderful thing. This is great because we are very likely going to stay in this net growth cycle for a longer period of time, I believe, than people think.
Yeah, I think that's very important to note is that especially the mid and late cycles, they tend to last a very long time. It's the recession and the early phases that tend to kind of be jerky and pop.
Yeah. Yeah. When you over anchor on some of the data points, and some people on TV do this, that show that, there's one blinking or two blinking signals that
Mhm.
show recession, you forget about the 27 other blinking signals that show early cycle, recovery cycle, mid cycle.
Yeah,
And it's the weight of those other signals that really have us really in a early still to mid cycle,
yeah.
which is a very good situation.
Lots of reasons for optimism. And I say that because as we transition to this next slide, which is a little disappointing when you look at DC specifically.
Yeah, so the world's largest employer, the United States government, is probably going to have fewer employees. It's already sort of started and will continue very likely for some time. It's, I guess the view is removing some of the bloat in excess, and certainly there's some, and this chart illustrates it, right? So you see very specifically Washington D.C. the amount of jobless claims has risen threefold. So that's a 3x change, uh,
Hmm.
and we think that will continue probably for a few quarters. Now, at the national level, we believe that the amount of layoffs at government could and should amount to a level where the Fed will cut rates, right? The Fed's
Yeah.
dual mandate is full employment and price stability, which in English is the unemployment rate and the inflation rate, right?
Hmm.
So as the unemployment rate rises, it rose 1 basis point this morning from 4 to 4.1, and we think it will continue to 4.2, 4.3, 4.4, 4.5. The Fed will cut rates.
Okay.
It is the other thing they're focused on. They just haven't been so focused on it over the past couple of years because the other thing was screaming at them, which was inflation.
Yeah.
Now that has, stopped screaming at them. It is unemployment that is going to get the Fed to act for sure.
Okay.
Just you wait. Now, look, if you're a person who wants the Fed to cut rates, you could game the system and create a lot of unemployment if you're the world's largest employer by
Hmm.
laying people off, forcing the Fed's hand. I don't know if that's happening,
Right.
but I wouldn't rule it out
Okay.
if you can read between the lines.
So let's have this conversation because I know that there's probably some listeners saying, okay, but we have this tariff issue.
Yeah, so if you do some research rather than just listening to the data points and you look at the tariffs and VAT taxes and offset taxes that we pay on foreign goods when we either buy them or export them overseas, you'll see that most of the tariffs are against us, right?
Mhm.
And that goes just about for anywhere we do business globally, globally, right?
Okay.
And obviously, right now, the push is, well, take those off. We've helped you for a long period of time. We've subsidized various things. We're responsible for the growth in China over the past 50 years. We gave them our jobs, let's call it past 20 years. We gave them our jobs, we gave them opportunity, we gave them money, and we still have these unfair tariffs and offsets still applying. So
Hmm.
the argument is, well, it's time to get fair, and you just remove all the stuff you have against us, and we'll continue to do business the way we're doing business, just without subsidizing it.
Hmm.
Well, it doesn't go over well, especially when you present it to countries quickly.
Hmm.
Like, well, we didn't forecast that, we hadn't planned on that.
Correct.
And what this country is now saying under this administration is, I don't care. This is what we're going to do, and if you don't do it, well, we'll just put the same tariffs that you have on us on you.
Right.
So ultimately, we have the leverage. Now, whether countries view it that way or not, they will view it very soon. We're the largest consumer in the world,
Hmm.
period.
Yeah.
And for the most part, everywhere, to everyone, right?
Hmm.
We have a tremendous amount of wealth. We love to consume. Americans are known for spending,
Hmm.
buying stuff in shopping. And that is what we do.
Yeah.
And that fuels the rest of the world's growth for the most part, right? Because if you really think about it, most of the world is an export-based economy, right?
Yeah.
We're not. We're a consumer-based economy,
Absolutely.
right? So
80%, I think,
ish.
ish.
So when you pull businesses, not people, businesses who are more familiar with how tariffs work, the polling of businesses is not what you think.
Hmm.
So this comes right from the Kansas City Fed. They do business surveys. One, two of the questions that we highlight here: how do you believe recent trade policy changes will affect demand or revenues for your business over the next year? 67% of firms say that there will either be no impact or increased demand or revenues.
Hmm.
Okay. The second question is your firm facing higher costs, input and labor? What share of those costs are you able to pass through to consumers in the form of higher prices? 7% actually said decrease prices.
Decrease.
Yeah, right. Because they're viewing it not on a just over 90-day period. They're viewing it on a full year, multi-year period. So, well, price is going to come down, of course,
Right.
right? Because there's less of a barrier. 0 to 20%, uh, uh, 39% of the respondents say 0 to 20%. So when you glue it together, 46% of firms say tariffs will either have a decrease or somewhere between a 0 to 20% increase in cost. So it's not what you think.
Right.
It's just not what you think through the lens of businesses, because they are looking beyond the, in essence, the one-time adjustment if tariffs go into place and stay in place.
Hmm.
I think they're viewing it as, well, there will be an adjustment to the other side as well.
Yeah.
Yeah.
Absolutely.
So again, I think it's a lot of bark, may not be a lot of bite. And I think if you just project forward a couple of quarters, I think what we'll be talking about is, here are the deals that were done. Here's how other countries brought down their charges, in essence, for our stuff, so on and so forth.
Okay.
More to come on that, but
More to come. It's a great point. I love this survey. And if you believe that the Fed is going to cut rates, let's take a look at what they're looking at, which in this case is one of the things they look at is PCE.
yeah, how about that 2% inflation? Now, keep in mind the Fed's preferred measurement of inflation is PCE,
Hmm.
and core PCE, not CPI. Uh, PCE, just think about it as items that we consume, brand names plus the alternatives. So not just Sunbeam bread, Sunbeam in the Walmart bread, right? So the ability to have an alternative in there.
Hmm.
And when you look at the PCE data, what the Fed uses, both measurements are in the twos.
Yes.
Now, the Fed does now measure live prices, and we show this to you here, that the live prices, live PCE versus the stale inflation data, is
Hmm.
lower.
Correct.
And this is through the Fed's lens.
Yeah.
It's lower.
Hmm. And this is their target.
We're near it.
Pretty darn close.
Pretty close, Julina.
So with this point, let's talk about the expectation of how many cuts we think they're going to do.
Yeah, another reason not to watch television, especially financial television, is the Fed speaks in this vague Shakespearean tone intentionally to buy themselves some slack in time and to add a little confusion to the mix, right? It's their narrative. That is what they do. They're really good at it.
Hmm.
We love reading between the lines and reading the tea leaves and decoding them and all that stuff. But ultimately, the Fed speaks and then the market prices in what it thinks it heard, right?
Yeah.
If we go off of the market expectation any single day or any single week, you're going to lose a fortune, right? But here you go for the month of February. Uh, the market was pricing in, based on Fed language, there almost being no cuts, all the way now back up to 3 cuts this year.
very quickly.
I mean, that what a monumental shift.
Hmm.
And the Fed hasn't said anything in a month,
Right.
right? So they'll be meeting next week. And again, if you went off of what they said in September, it's very likely they'll cut quarterly,
Okay.
right? Cut a quarter per quarter. That gives you the four cuts.
Hmm.
In December, they said, well, look, there's a lot of stuff that's going to need to be hashed out, specifically because of the administration change, trade policy, and employment levels and inflation and all this stuff. We don't know how it's going to work out. We don't know what's real. We don't know what's you know hot air. But as we know more, we'll figure it out. But hey, we don't want to commit to four cuts. We think that there'll be a lot more clarity in the second half of the year.
Hmm.
Code for, yeah, we'll be cutting in the second half of the year,
Yeah.
but also no promises. They hedge
Hmm.
everything they say. So the market overreacted. It sort of priced out cuts. And in some cases, you heard some of these clowns on TV saying that there were going to be rate hikes, increasing rates.
Right.
Yeah, well, that's great. The Fed's going to put us in a recession. I don't think so. So now we're back up to three cuts. And I can tell you it's very likely we will have three or four cuts this year. We'll probably have more next year
Yeah.
because inflation over time is going to arc down. Unemployment's going to arc up a little bit. And the normal rate environment that the Fed keeps talking about, 2.5 to 3% short-term rates. Well, rates are going to have to come down to that. We'll probably have the 10-year Treasury come down. It just doesn't happen overnight. We need a little bit of time to do it. So
Yeah.
don't get caught up in the minute by minute soundbite. Measure over a longer period of time. And in this case, this is 1 month.
Yeah.
1 month.
And I think this is so important because I can't tell you how many clients and individuals have asked me, well, your firm has changed your view, right? And
No,
what you're trying to say, Bob, is no, our view has not changed.
no.
Okay. Yeah. Thank you. Let's talk a little bit about the consumer because we were addressing earlier the strength of the consumer, the importance of the consumer in our economy, but it's also important to know the makeup of the consumer.
Yeah, look, it's I mean, this is a tough one to talk about, but ultimately, on the right-hand side, you have consumers in aggregate, but broken out into tiers of earners. So the lowest tier of earners, the next tier of earners, the next tier of earners, so on and so forth. And what you can see is the top half of income earners account for 80% of all spending. So the top 50% of all income earners account for about 80% of all spending. When you're hearing things about weakness, and we've talked about this over time, the tale of two consumers, right? Yeah, there's weakness amongst the bottom tier of consumers. There is always, unfortunately, weakness. Uh,
Hmm.
what is certainly hurting them is the compounded amount of inflation that we've seen over the past 4 years, right? Even though the growth of inflation is slowing, it doesn't take away the 22% amount of inflation that came at us very quickly,
Yeah.
right? You mix that with higher prices for stuff and higher cost of financing, which is primarily impacting the lower earners, right? Because ultimately you finance everything.
Hmm.
30% credit card rates, 8% mortgages, 12% car loans. Where you see the brunt of that is typically in the lower earners. Yeah, they are feeling the pinch for sure.
Hmm.
And they voted, and we received whatever outcome we received. They're feeling the pinch. They spoke up and they said, yeah, what you think is happening. But I can tell you, when you look at consumption by income group, who really moves the needle in the economy,
Hmm.
again, at 80% of it is the top 50% of earners.
Correct.
So, in aggregate, even though there's some weakness, the consumer is very, very strong.
Exactly. And I think the one slide this month, there's always one that kind of shocks me. It's probably this one, looking at the U.S. relative to some of the other major nations around the world.
Yeah, you and I almost fell out of our chair when we were looking at this one. So great chart from Apollo. They charted out household debt to disposable income. So if you want to get a good measure of consumer balance sheets in the United States relative to the rest of the world, we're going to show you two developed nations
Mhm.
relative to the US. And what you see here is household debt to disposable income ratio for consumers in the United States, remarkably low, very, very, very low, and very low relative to the very developed, advanced economy, Canada and Australia.
Hmm. Yes.
Unbelievable. Unbelievable. So the US consumer relative, we could put the rest of the world on here too, will still look better. But the US consumer relative to the rest of the global consumer, we are in phenomenal shape. Again, as a whole, as
Yes.
so don't pay too much attention to credit card defaults and some auto loan defaults, all that stuff.
Hmm.
You know, if it needs to continue to spike for a couple of years to get to a historical average level,
Yes.
right? We are still below various levels. So keep that
Yeah.
in mind.
And it's fascinating that divergence really occurred after the financial crisis.
Mhm.
Yeah. Thank you. And what about real estate?
Yeah, real estate. So something has to change. It's already starting. So the 10-year treasury, the long rate, which is, what's tied to auto loans and mortgages is coming down a little bit, which is great. It's probably going to lead to a lot of refinancing. But what you're seeing here, again, not in the Northeast, but what you're seeing is Texas and out west and Chicago. There's a lot of turnover. There's a
Hmm.
lot more inventory. There's a lot more stuff starting to happen. Something has to change, and the big change is going to be really mortgage rates or long-term interest rates. And you're hearing the Treasury Secretary talk about it. You'll hear the Fed talk a little bit more about it. They just started last meeting. You're hearing people in the administration starting to talk about it, and that will very likely lead to uh, uh, some other stuff. But ultimately, what's going to change is longer term rates are very likely going to come down, which creates opportunity for refinancing, both at the residential and commercial side, which is needed. And I believe real estate will be in a better spot soon.
Okay.
Not yet, but
Yeah.
soon. Soon.
Yeah. And on the topic of real estate, I think it's important to address mortgage rates and the effect that it can have on affordability.
Yeah. So when longer term interest rates rise, keep in mind the 10-year treasury 5 years ago was less than 1%. Now it's 4.25%. What does that mean? Well, it means mortgage rates go from 3% to 8% quickly.
Mhm.
If that happens, a house becomes very unaffordable quickly. And that's where we are. So the amount of income needed to buy the national average price house in this country 3 years ago was about $55 to $60,000, and the income needed today to buy the U.S. national average price house is now just shy of $100,000. So things have become very unaffordable very quickly. This doesn't really register in the inflation calculation well,
Mhm.
because it is more sensitive to rents, but home ownership has become near impossible for the average person in this country over the past handful of years, primarily driven by significantly higher interest rates.
Right. And the other issue has been inventory.
Due to higher interest rates, yes. So what we are starting to see here
Yeah.
is changing inventory, starting to see a lot more inventory. Again, not in the Northeast. So if you're listening in New York or Connecticut or Pennsylvania, Massachusetts, yeah, there's no inventory. There is
Yeah.
no inventory. And the inventory that's out there is generally stuff that needs to be renovated, that really hasn't been touched in a long period of time. It's not the ideal stuff. But in the rest of the country, certainly in the South and out West, and if you're listening to this in Florida, you know there's many more condos for sale than there were 6 months ago, 9 months ago. That's good. You're going to
Yeah.
see a lot more activity. Again, if you take lower rates and more available housing, you're going to see a lot of activity. A
Yeah.
lot of activity, keep in mind, is phenomenal for the economy, because you move, you rent trucks, you buy boxes, you buy
Yeah.
new dishes, you buy new appliances, you go to Home Depot, buy lawnmowers, all that stuff. So there is a silver lining to this very odd, tight real estate environment we've been in on the horizon. And this improves the economy when there's activity, and it's
Yeah.
it's coming. It's just not here just yet.
That's great. And the last section of our webinar is this everything else, and we just have a couple slides we can quickly go through to highlight for our listeners.
So yeah, the USA Strategic Crypto Reserve. Yeah, this was announced. It was re-announced. It wasn't new. It was re-announced recently, which sparked a little bit of movement in cryptocurrency because it's starting to fall from its peak a little bit.
Mhm.
Um, but the U.S. government is going to create this crypto reserve. Like we have a gold reserve, and it already owns some of this stuff, but it mentioned by name these various forms of cryptocurrency, Bitcoin being the biggest. You can read the other names on the screen. The diamond on the bottom right is Ethereum. So, what does that mean? Well, that means that the US is building some type of reserve. It's very likely viewed as an investment to a degree. It doesn't really know the use value just yet. It just wants to have a little bit of exposure to it.
Yeah.
Um, and what does that do? I don't know. I think it could support prices a little bit for crypto. Number one. Number two, it could be an investment that could pay off over time.
Hmm.
But keep in mind, a lot of other countries that own this stuff hate us. They, don't want to see America do well.
Yeah.
Certainly if you're China or Russia or all these other cryptocurrency investors, Iran, Iraq. So who knows? I hope we don't get manipulated by owning this stuff, and I hope it does work out. Too soon to tell. The full intent of it and the usage of it over time through the lens of government is not articulated just yet
Hmm.
because I don't think they know.
Right.
So more to come on this, but you will hear about it. But the next slide, for those that invest in Bitcoin or want to invest, this is a phenomenal chart. So we have shown charts where, as an investor in the stock market, if you missed out on the best 10 days for a year,
Hmm.
your return is going to be substantially different than if you just held on to the market, right?
Correct. Yep.
If measured over 2 years and 3 years, it is a substantial difference. You
Yes.
want to be invested in the market. You want to commit to it and own it for a long period of time, right?
Yeah. Historically, over a 10-year period, it takes half the return away.
Absolutely.
Yeah.
Well, Julina, in this case, if you haven't owned crypto for the 10 best days in the past decade,
Hmm.
how about this one? Just the 10 best days in the past decade, you have a negative 44% return. This is mind blowing.
Yes, it is.
So it just tells you have to feel the pain, and keep in mind it's painful more often than it's joyful.
Hmm.
And you have to just take it on the chin,
Yeah.
stay invested in this very volatile asset class to get exposure to the 10 best days over a decade's period of time to actually have the return that
Hmm.
you want
Yes.
positive in this stuff. So again, just points out that even optically, it is very difficult to own because it is so wildly volatile. And if you miss out on just the 10 best days over a decade span, not knowing when they'll come, mind you,
Hmm.
your return is horrendous.
Horrendous. Yeah.
So if you're going to commit to something like this, you are marrying it for a very long period of time.
Yeah. If you're going to complain about the volatility of the S&P, be
Yeah,
prepared, right?
be prepared for 4 times the volatility.
Yeah.
You really have to marry this stuff for a long period of time. This is
Yeah.
not something that you invest in for a year or three. This
Hmm.
is a decade-long commitment. So
Yep. Nope.
just
I love this slide. One last slide. We always like to end on a very positive note.
yeah, so after we suck people into watching these videos for 30, 40, 50 minutes at a time, we're very thankful for that because time is the most precious resource that we have. We will not get more of it. So you really need to care for it, cradle it, and protect it.
Mhm.
More specifically, this slide illustrates how people can just waste their time and scroll their life away.
Mhm.
This is a chart of time spent, daily time spent on and with media in different forms of media, whether that's internet, outright via mobile phone, TV, social media, music streaming, playing games, listening to podcasts, reading newspapers, so on and so forth. Today, on average, it's shocking. We spend 400 minutes with on next to within the media,
Hmm.
all forms per day. And then on
Pressing.
the bottom right hand chart, we show minutes per day spent over our life cycle with friends and family and children and coworkers, and then the amount of time we spend alone. And I got news for you. We're all going to be spending more time alone, without our kids, without our grandkids, without our partner over time. So while you're alive, spend your time wisely. Spend it with people. You'll have a better life. Really protect your time. Do the things you want to do. Apologize to who you've been wanting to apologize to. Make up with who you've been wanting to make up with. And go hug your kids. Go hug your partner. Be nice to your coworkers, because you're not going to be spending a lot of time with them going forward. It decreases incrementally over a long period of time.
Yeah.
Use your time wisely. And thank you for spending any time that you've spent with us listening to us talk
Yeah.
about this stuff. We
Yeah.
appreciate it. We don't want to waste it. That's why we get very granular and we try to articulate things to you so you can live a better life, pay less attention to what's going on, certainly in the markets, hopefully in the world.
I would also say that our other goal is to lower anxiety of investing and staying invested long term. So hopefully we've given everyone enough data to help them understand that we do still have a lot of positive views of the market ahead. But again, it's just maybe putting our seatbelt on for a little while.
Yeah, and when we have negative views, we will share them for
Yeah.
sure. Um,
Yes.
it's just when we're in a bull market cycle, it tends to last about 8 years. We're 3 years in. We don't think we're near the end of the cycle just yet, anywhere near it.
Yeah.
But when we do get there, we will tell you.
And it doesn't always feel like we're in a bull market, but it's easy to look back after, right? So,
Absolutely.
as always, we appreciate your insight, Bob, and thank you everyone for your time. And we look forward to another detailed webinar in April.
We will see you soon.